Hi, my name is Chu Chi-en.
My name is Chao Yu-san.
My name is He Zhiqing.
Today we are going to talk about how might a better application of ASX Corporate Governance Principles have prevented corporate collapse and other business scandals. So, what is corporate governance? It is a system by which business corporations are directed and controlled. Organization of Economic Cooperations and Development defines corporate governance as procedures and processes according to which an organization is directed and controlled. It specifies the distribution of rights and responsibility among different participants in the organization and lay down the rules and procedures for decision making. It also provides a structure which the company objectives are set and what are the ways to achieve those objectives and to monitor performance.
WorldCom was once the second biggest long-distance phone company in US. However, it was filed for bankruptcy in 2002 as one of the biggest accounting frauds in the American history. Between 1999 and 2000, WorldCom overstated its pre-tax income by more than $5 billion. This overstatement was caused by fraudulently reducing reserves and capitalizing operating expenses. After the reveal of this scandal, the stocks of the company became relaxed and 17,000 of jobs were lost because of the scandal. Therefore, WorldCom leaders all went to jail.
Here are the 8 ASX Corporate Governance Principles. Today we are going to use 3 of them, which are number 4, safeguard the integrity of corporate reports, number 6, respect the right of security holders, and number 7, recognize and manage risk.
The first principle we are going to talk about is to safeguard the integrity of corporate reports. This means that a listed entity should have appropriate processes to verify the integrity of its corporate report. It also can be explained by a company must be transparent and uphold integrity when coming out with their financial reports so that the public can trust the company and continue to invest in its stocks. In this case, WorldCom tried to cover up its decline in profitability and they exaggerate its net income and cash flow by recording expenses as investment. The mistreatment of expenses heavily deviated from this principle and were not in accordance with the generally accepted accounting principle. Therefore, their financial reports do not guarantee integrity. Some tips for WorldCom to improve is to have a separate audit committee, which can be an efficient and effective mechanism to provide transparency, focus, and independent judgment required to supervise their corporate reporting process. They can also have declaration from the CEO and CFO, so that they can first ensure the financial records of the entity for a financial year have been properly maintained in accordance with the Act, and they can also financial reports and the notes for the financial year in compliance with the accounting standards, and lastly, reflect the financial position and performance of the entity in a true and fair manner.
Next, principle number 6 is respect the right of security holders. This means that a listed entity should provide its security holders with appropriate information and facilities to allow them to exercise their right as security holders effectively. In this case, WorldCom have lack of independence and awareness in audit committee. The external auditor opinions were ignored by the board of directors. The auditors are lack of professional skepticism and demonstrate no sense of responsibility in their work. The external auditor, Arthur Anderson, have a close relationship with the CEO, Bernie Ebbets. WorldCom shows no transparency to the security holders, therefore did not respect their rights. Here are some tips for WorldCom to improve. First of all, they should have an independent audit committee that have no relationship with the management. Secondly, they must be transparent in their disclosure of information so that the security holders' rights are respected.
The last principle we use to apply in WorldCom case is recognize and manage risk. It means a listed company should complement an effective and efficient management framework. An entity should establish a sound risk management system, identifying the risks existing in the framework, and regularly review whether it is consistent with the rule of law. The principle helps entities to promote transparent markets, minimize risk, and improve the overall economic performance. In this case, WorldCom has wrongly recorded total profit on their annual financial statements. The reserve funds are abused when financing, and they deliberately exaggerate it to increase profits. They incurred too much bad debts, which motivates them to fraudulent reporting. The huge amount of accounts receivable leads to a capital break and slows down their cash recovery. Due to the high risk in their financial management, they incurred more liability, which reduced their profits. Here are some suggestions for WorldCom to take note of. First, they can introduce new management system to assess risk. Next, they can improve by monitoring auditing work to ensure the management framework is effective. They should have clear distribution of responsibilities of managers. Next, they can implement appropriate control measures to improve the existing risk management framework. Lastly, WorldCom can propose risk management policies and conduct self-evaluation process to examine their own strengths and weaknesses.
In conclusion, the failure of WorldCom is caused by not complying with these corporate governance principles. They should ensure that all their financial reports are transparent.
All board members should be independent.
Disclosure material information that respect the right of security holders.
Maintain the communication between security holders and top management through providing true and fair annual reports.
The risk management framework should be effective.
These principles are the key to avoid corporate failure.
That's all.
Thank
Thank you.